So today I'm just going to be going over credit. It's supposed to debt, not debit. So credit versus debt. We're going to learn about like good debt versus bad debt, and then about like credit scores and things like that. So there's a couple definitions. So debt is just the state of owing money to a person or a business. Usually people refer to debt as like, oh, I haven't paid off my car payment. That's a debt. You owe the bank money, or you owe whoever you got the car from money. Um, or a house. Everyone usually has house debt for a couple years. You just owe someone, usually you owe your bank money. And then credit is when you borrow money from a person or financial institution with the agreement that you'll pay back the money you borrowed. So usually like that comes in the form of credit cards. And credit cards are payment cards provided by a financial institution that allows for you to borrow money with the understanding that you'll pay that debt back. And usually credit cards have fees attached to them, but we'll go over that in a second. So, what is credit used for? Credit, I forgot to mention this, but it doesn't only come in credit cards. Also, like taking out loans, borrowing money from a bank or a person is still considered some sort of credit. You're spending money that you don't have. You're spending money that someone else has instead. So, for example, cars, if you want a Tesla, they're usually like I think it's safe to guess they're more than like $50,000. I don't have the exact amount, but you know they're expensive. No, most people don't have that amount of money on them like at all times. So you might take out like or you might not take out a loan, but you might finance your car with the car company you bought it from and just say I'll slowly pay back what I owe you for the car. For a house, you usually get like a house like a I don't think it's called a house loan, but it is a loan to get your house. And you do it with the promise that you're going to start paying back the money that you owe them for owning your house. And then you usually also use it for college, student loans that parents usually like to talk about all the time, and they always bring it up. It's just because college costs so much money, you usually need to borrow some sort of money from a bank and then slowly pay them back over time. And it usually kicks in like after you graduate college. And then sometimes you just use it for random things like shopping. I know I have a friend, she actually told me a couple days ago she owes like $500 just in shopping on her credit card. I wouldn't suggest doing that, but you can do that. You can use it for all sorts of things. So then we have a credit score, which is tied to almost like everything you do that's financial. Whenever you get your first credit card or take out your first loan, you get a credit score. And it's basically a measure of a couple different factors, like your spending habits, things like that. Or not spending habits, but how fast you pay back money you owe, things like that. And they give you like a score. And obviously, the lower the score, not as good, doesn't look as good for you. Higher the score, the better. And the thing about credit scores is that people look at them all the time. If you're applying for a certain type of job, not really part-time jobs, they don't really look at your credit score, but for other jobs, they might take a look at it just to see how responsible you are with money. Another example would be like when you buy a house, that is probably the most common example of using your credit score to like take a look at you. Sure, you might say, "Oh yeah, I'll pay for this house or whatever." But your bank might take a look at your credit score and realize that you're not the best with money, or they might take a look at your score and realize that you're actually pretty good with money. And from there, they'll determine whether or not they give you a loan or anything like that. And so the different factors, you have payment history, credit usage, how much have you borrowed? How many times have you asked for a loan? Or how many times or how often you use your credit card? The length of credit history, so just like how long have you been borrowing money, which that's not necessarily a bad thing. Credit types, it's kind of self-explanatory, and then also like how well you pay back the money. Some people They'll have like late fees, they'll pay back their owed money late. All of those things don't look good for your credit score, and they do go into account in your credit score. So it's really important to pay attention to those things, pay everything on time. So the thing is, there can be good debt. It's not necessarily a bad thing. It really just depends on how capable you are of paying it off and also what it gets you in the future. For example, investing in a business. Of course, you want to pick the right business, but if you pick a business that's actually has shows promise or something like that, investing your money in a business, we know we talked about this last time as like kind of like a way to make money. You can invest in a business, give them a certain amount of money just to start them up. They do pay you that back, and sometimes they pay you back with interest. So investing in a business can bring good money and in turn be good debt. Hopefully make you more money than the money you spent. Additionally, school, especially for doctors and like careers that tend to make like a lot of money, you do pay a lot for school and you get in big debt. However, the amount of money that you're making as like a top tier lawyer or a doctor or whatever it is you want to be, the money is supposed to like be enough to pay back those debts and hopefully make you allow you to live comfortably without worrying too much about paying those off. And then lastly, a house. The housing market always changes. Everything always changes in price. Um, you bought a house in 2008 in like the middle of a city when it wasn't a city and now it's a city, your house can definitely be worth a lot more money. It really depends on how the area changes. But if you're investing money in a house and you want to sell it later, it can definitely make you a lot of money. When you sell it, you can make a lot more money off of it. Or if you want to rent out the house because you have somewhere else to live, you do make money from that as well. And then we have bad debt. Bad debt can be an example of getting a credit card that has really high interest rates, which means they're expecting you to pay extra fees for using their credit. Um, there's also like excessive shopping or impulsive buying. One time I kind of impulsively bought a Nintendo Switch. I didn't buy it on credit, but this is just an example of impulsive buying. I bought it and I had no money to like go shopping with my friends like the next weekend. That's a very bad example, but it's an idea of impulsive buying. Impulsive buying with credit is also not a good idea. That all accumulates. And then obviously like shopping. Shopping is good, but it's only good if you can pay it back, right? If you know you can't pay back that money on time, or you're not making enough money to pay back that money on time, you should always just stick to spending what you have, not what you don't have. And then this is going into interest. What I was talking about, how there are fees, excuse me, sorry, there are fees attached to credit. If I take out a loan, there is an interest rate. It means I have to pay back a certain percentage of what I borrowed. So if I borrowed $100 and I'm borrowing, if they say like, I'm really bad with percentage math, so I can't give you a good example. But let's say you borrowed $100 and they're expecting you to pay $20. That's like a percentage of what you owe them. Or $25. No, $25, 25% of 100, I think. We'll go with that. So if you sometimes that's how banks make their money off of loans and credit cards. They're making money because you have to pay them back ever so slightly extra, depending on what plan you pick. Right. Oh, that was supposed to be on the same slide. All right. And then I know this lesson was quick. I didn't mean for it to be super quick, but we can go over some stuff in a second. But we're gonna do a little true or false just to see how well you guys retain information from what we just did or what we just learned about really quickly. So you guys can just like think of your answers and then we'll go over it in a second. So number one, paying debt late can hurt your credit score. We'll think about that. Number two, interest makes borrowing cheaper. Number three, certain debts are good for your future. And then number four, always double check your interest rates before choosing where to use credit. We can think about that. I mean, obviously, we can recognize a bit of vocab in here. Debt is money we owe a bank or a person. Credit score is like an accumulation of everything we do with our money. It's a score that kind of measures how well we are with money. Interest are extra fees that we pay on loans or borrowed money. And then interest rates, which I didn't exactly define. It's just that percentage. It's just how much are they charging you to pay? What is that extra fee that they want from you? Okay. Then the answers. Okay. Every single one of these was true. Minus interest makes borrowing cheaper. Interest is just extra fees added on top of what you have to pay back. So it doesn't make it cheaper. But depending on who you go to, sometimes people don't even make you pay back with interest. But if you borrow from a bank, it just depends who you go to. Paying debt late definitely can hurt your credit score. Like we talked about payment history, like it's all factored in there. Certain debts, we talked about like college or a house or investing in a business, those can always reap rewards. And then always double check your interest rates. Very true, very important when you're deciding who to go to borrow money from.